In this session, I'm going to introduce you to the world of counterparty credit risk, wherein we will be defining what is the counterparty credit risk all about. How do I really differentiate between counterparty risk versus a lending risk, because there is a lot of confusion that comes between these two forms of risk. So we'll talk about how do I differentiate between the two. And within this context, we will be talking about the settlement risk versus the pre-settlement kind of risk. And where does counterparty risk actually fit in? So that's one context that we are going to talk about. And the counterparty risk, how actually it exists in OTC derivatives contracts versus exchange traded. So where is the counterparty risk heavily present? Is it more in OTC or is it more in exchange traded, and why? That's a very important element for us to consider, right? And which kind of instruments actually the counterparty credit risk is much higher. Then we are going to spend some time on repos and security lending kind of activity. That is another major source of counterparty credit risk. So we want to talk about that aspect as well. And once I know what are the different sources of counterparty risk, we will be talking about what are the various ways in which I can mitigate the same. Any organization can get into the mitigation of counterparty credit risk, and towards the end we will also talk about who are the different kinds of players in the counterparty credit risk market. So this is what we will be looking at on a broader note in this particular topic, right? So let's get started one by one. Just a simple definition of counterparty risk. In some cases we call counterparty credit risk, otherwise simple counterparty risk. So it's a kind of a risk that if A has entered into a contract with B, right? If one party has entered into a contract with the other party, this other party is failing to fulfill their side of the agreement, right? If A and B have entered into a contract, now the counterparty risk for A is B is failing to fulfill their side of the contractual agreement, right? B is not adhering to the terms of the contract. That is what is coming under the purview of counterparty credit risk. And what we are seeing is there are two major classes of products where counterparty credit risk is found to be heavily prevalent. One being the OTC derivatives. Over the counter derivatives is where counterparty risk is much highly present, whether you take interest rate swaps or you take forex forwards kind of market, or even the credit derivatives markets, which talk about credit default swaps, etc. kind of products. Similarly, you are finding counterparty risk in securities financing kind of transactions, where we talk about financing using repos and reverse repos, repurchase agreements, or even we get into the securities lending and borrowing kind of activity. This is where you find counterparty credit risk to be much more heavily prevalent. So if you look at this category of OTC derivatives, this is very highly significant, very important for us to consider because of the size of the derivatives market, because of the diversity or the variety in the product categories that are available in the derivatives market. And in reality, there is very limited amount of collateral that is existing in the trades that are performed in this particular market. That is one of the prime reasons these markets are very heavily exposed to counterparty credit risk. Right? Now, a very interesting aspect that surfaces, okay, I will be thinking of mitigating the counterparty credit risk. Fair enough. I want to reduce counterparty credit risk, but we will be seeing that if I try to mitigate counterparty credit risk, it gives rise to various other financial risks. Right? That's a pretty big compromise that we have to make, because it is introducing various other financial risks. So when I'm trying to mitigate the counterparty risk, I should have a very good understanding of the different financial risks, basically where we talk about the market risk, the typical credit risk, the operations risk, the liquidity risk. All these things, there is a possibility of they cropping up heavily during this mitigation of counterparty risk. And the interaction between each of these risks, the correlation between each of these risks is also a very critical part. So which means if I have to deal with counterparty risk, I see that it's a very complex process. There is a possibility of systemic collapse if not handled properly, and it can cause very serious disturbances in the financial markets, a very serious trigger. And probably this is one major risk that has contributed to the global credit crisis as well. So which means there is an important need to understand, quantify, and even measure the counterparty credit risk. So that's where the whole focus has been driven towards the understanding and mitigating, quantifying, managing, mitigating counterparty credit risk. And this is what is very essential if the OTC derivatives market has to flourish heavily, grow drastically in future. Otherwise, there could be an hindrance on the stock. Right? Now, sometimes I keep getting question, what is the difference between the counterparty risk versus lending risk? Right? Because we define counterparty risk that one party failing to adhere to the contract. A and B have got into a contract and B has failed to adhere to the contract. And that is what we have defined as counterparty risk to A. So it looks like, okay, A has lent something to B and B did not pay it back on time. So that is the reason why counterparty risk came up. But this is where I have to differentiate. Right? So there is a general tendency that people think that these two are equal, where A has lent something to B, B owes A, and he fails to pay because of unwillingness or inability, whatever it is. There could be an insolvency with B, and that is where B is not able to pay to A. And this kind of mechanism is applicable. Okay, A has taken a loan from B, or A has invested in the bonds of B, or it could be a simple mortgage. Again, A has taken a loan, or B has taken a loan from A, or even it could be a credit card. Any such kind of a product, B owes some money to A but is not able to repay. Right? This is what actually happens as a part of the lending. But if you look at some of the characteristics here, the notional amount, right? The amount that one party has to pay to the other is to a large extent known with certainty, the principal amount or whatever are the outstanding interests. Though the market interest rate right? Even if I have taken a floating rate loan, the market interest rate is volatile, but still the difference, the change, right? The uncertainty that comes is very limited. There will not be a drastic change in the amount. And even if you are talking about, I'm using a amortization kind of a payment, right? When you are talking about a mortgage and there is an amortization where portion of principal and interest are being paid, even there I can predict with a decent amount of accuracy what is the kind of balance that is outstanding to be paid. So even when we are talking about a credit card or a loan, we are still talking about the maximum that is possible to be spent. There is a maximum limit or a cap that is existing. So to a large extent, what we are saying is something to do with the lending. There is a level of predictability that is built into it. That's one major aspect. But what we say is in a counterparty, that level of predictability does not exist. The value of the contract is typically unknown. And even it could be a significant difference also, right? Because I don't know the value of the derivative at any future date. The value of the derivative at any particular date, at that particular default date, what could be the value? It could be positive, it could be negative, because at that point, whatever is the present value of all the future cash flows is what is going to constitute the value of the derivative. It could be positive, negative, it could be highly volatile as well. So that is where we are talking of any of the party can default. It could be party A as well as party B who can default here. Whereas when I talk about the lending risk, it's only one party who takes the risk. It's only the lender who has the risk. The borrower does not have the risk, right? But in the counterparty risk, it's purely bilateral. It has to be bilateral. Any person, it could be A or B who have got into the contract, they can very well be exposed to counterparty risk. Each counterparty has a risk to the other, right? So here also, though I say it is the obliger who is not in a position to meet the contractual obligation, but I don't know here who is the lender, who is the borrower. Any party, right? Because it is a kind of a contract. At some points in time it could have a positive value where A has to pay to B. In some cases it could be a negative value where B may have to pay to A. So there is nothing called this party is the obliger, this party is the obliger or lender or borrower in this particular case. So the value, so basically if I have to differentiate a counterparty risk from the lending risk, two major things. One, the value of the contract is very much uncertain compared to that of a lending risk, both in magnitude as well as in size, and it's a pure bilateral contract. Any party can have the risk against the other party. Now this is the way I can differentiate the counterparty risk from the lending risk, right? Now another aspect that I bring here is settlement risk versus pre-settlement, right? The risk that is occurring at the time of settlement, the risk that is occurring before the settlement. Now if we are talking about any typical derivatives portfolio, we are having so many settlements, right? There are a lot of settlements which are equal to the multiples of the total number of trade, right? Now what we say is pre-settlement risk, right? Now what we say is pre-settlement risk is something which is closely associated with the counterparty risk. So what is this pre-settlement? As the word itself is saying, it's a risk of default before expiration of the contract. So one party can very well default before the expiration of the contract. But when we are talking about a settlement risk at the time of expiration of the contract, during the settlement process, after expiry of the contract, during the settlement process, any kind of risk that comes out, that is what we are categorizing as the settlement risk. So basically the settlement risk comes because of the timing differences. Okay, clients A and B. A is in US and B is in UK. The timing differences where each party has to perform the obligation. So it is or if there is a flexibility of payment during the entire month. So one party pays in the beginning of the month, whereas the counterparty has to deliver it somewhere in the middle of the month. So that much time period, that is the settlement period. And any default that is bound to occur in the settlement period, we are associating it to the settlement risk. Whereas in case of pre-settlement, we are simply talking about the default that is occurring before the settlement of the transaction, and counterparty risk fits a lot here. But now, a few more differences if I want to see with respect to the settlement risk. Here the loss is very, very large. So the exposure is very, very large. Right? If I lose, one side has performed, the other side has completely absconded. So it's a big loss that can occur. And whereas it can be more complex, and especially if there is a large delivery period, like a month window, right? So one party can perform anytime during the month, the other party can also perform anytime during the month. But when it comes to pre-settlement risk, it is the probability of default is much higher in this case. Here it's the amount that is defaulted. The probability of default could be much lesser here in settlement risk. The probability of default could be much lesser, but in case the default occurs, the loss that would arise is going to be significantly higher. Whereas here the probability of default is much higher, the severity of the loss may not be that higher. So every derivative trade has both the pre-settlement risk as well as the settlement risk. And the balance between the two clearly depends on, clearly is understood based on the type of the contract. Because if you look at some spot contracts heavily have a settlement risk because it has to be settled on the spot itself. So there is nothing called future, so there is no scope for pre-settlement. But if we are talking about long dated kind of contracts, we can very well think that the default can happen somewhere in the middle. So there is a possibility of a pre-settlement risk coming up. And different kinds of mitigation tools, right? We'll talk about them in detail, but if I'm doing a lot of netting, which is an important mitigation tool, so or probably we have some kind of collateralization, different such kind of tools, they help us in mitigating against the settlement and the pre-settlement risk, right? And as I said, in the settlement risk, the exposure is much higher, and it could even go to the extent of 100% of the value of the trade, right? Because one party has adhered to the contract, the other party is simply absconded, so the loss could to the one party could be entire 100%. So typically in the forex markets, we see that this is a very serious problem. So I'm paying in one currency and I have to receive in the other currency. And if trades are not cleared through, let's say, a CLS, which is the multi-currency cash settlement system. So if they are not getting cleared through CLS, this is where I could sense the losses that could occur to a very severe extent. Similarly, if we are getting into a securities financing transactions, even there is a possibility of high settlement risk, right? And a few more interesting points regarding the settlement risk. It actually occurs in a very short time frame because it occurs only during the settlement period. So it can occur only during a short period of time. In some cases, it could be a few hours, whereas in some cases, if the settlement window is probably a month or a few weeks, then probably it could the settlement period goes into a few days. So we have to look at the contractual payment days, right? What all have to be looked at? What are the payment days for the contract? What are the time zones? There could be a time zone differences between the two parties. So that has to be looked at, and how often the reconciliation is happening. If the reconciliation is very frequent, we don't find the settlement risk to be a large time frame, right? The risk would be only for a shorter period of time. So banks have to very clearly focus on measuring the settlement risk, but make sure that they don't do a double counting by including it along with the pre-settlement risk or the counterparty risk. So they should have separate limits both for settlement risk as well as the pre-settlement risk. Measure the exposure against this limit rather than getting into the settlement risk as a part of the pre-settlement risk. So that is how the banks have to really get into the addressing of the settlement risk. Now, let's try to talk about the exchange traded derivatives versus OTC derivatives. What is the level of counterparty risk that could exist between in these kinds of products? So we know different kinds of products are traded on the exchange, where exchange is like a intermediary facilitating all the contracts. We know that the contracts that are traded on the exchange are very much standardized. We have futures and options traded on the exchange, and exchange actually focuses on promoting market efficiency. We know that, right? Any product that gets traded through exchange, it's promoting the market efficiency, and liquidity of that particular product is very much enhanced in the exchange based market because there is a centralization that is happening in the trading. So if at all a particular contract has to, or if at all a particular product has to get traded in the futures on the exchange, there should be a heavy volume, a good volume where a lot of participants should be there. There should be a lot of standardization, and there should be a lot of liquidity that is associated with that particular product. And exchange really facilitates the price discovery process. We know that, right? Because the prices are discovered through the demand and supply for that particular product. So it helps in coming out with the price discovery for the product, and it plays a very important role in mitigating the counterparty risk because there is a kind of a central clearing. The clearing is done by the exchange or the clearing house, which is a part of the exchange. There is a central clearing that happens. So to a large extent, I can say that the products that are traded on the exchange, they rarely have any kind of counterparty risk. Whereas when I come to the OTC market, yes, products wise, we say that there is a lot of customization that is available in the products, right? And so because of this customization, between the two parties, only two parties with their own negotiated terms are entering into the contract. So today the notional amount is much higher in the OTC market compared to the exchange based derivatives market, right? And there are lots and lots of exotic products, non-traditional products that are getting traded, right? Newer and newer products, credit derivatives kind of products are getting traded on the exchange, on the over the counter between the parties. So it's more and more of customization that has really created a market for the OTC derivatives. And today we have different kinds of OTC derivatives that are ruling the market, especially the interest rate based derivatives. They are very heavily traded. Similarly, we have foreign exchange based derivatives, forwards, etc. And credit default swaps, another big market in the OTC space. Though we have a few on equity, commodity kind of derivatives also, but these three dominate the market in a very big manner. Interest rate base, the foreign exchange base, and credit default swaps. And again, different of them have different different kinds of features. Now, if you look at majority of the forex products, they are short-term products, right? And let's say we are talking about the interest rate swaps or cross-currency swaps. We are talking about the long-dated, right? So they carry a lot of counterparty risk because they are long dated. And credit default swaps, so okay, here the volatility is much higher, but at the same time they are exposed to what is called as wrong way risk. Very important word, right? If I have to understand wrong way risk, I have to understand how a credit default swap works. So which I will be taking it up slightly later. But yeah, we can very well understand that along with the volatility, there is a heavy presence of wrong way risk with respect to credit default swaps. So the interest rate products are a very significant portion of the counterparty risk compared to forex products or even the credit default swaps. Now, another important aspect with respect to derivatives and their exposures, right, compared to the underlying products. What we could see is exposure is very much smaller compared to a traditional bonds or whatever. Because we see here, let's say in an interest rate swap as an example, no principal is exchanged and at regular intervals of time, only the difference in the interest rates between the fixed and the floating are exchanged. It's not even the full amount. So if a counterparty is defaulting, then first of all, there is no obligation to continue the future payments. I can very well stop the future payment, and the swap is unwound based on the independent quotations, right? And it is computed to the current market value. So if at all this market value is negative, so they don't lose anything. So even if the counterparty has defaulted, the loss is nothing. And if it is positive, even it would not be a significant amount. The significance is much lesser compared to that of an underlying product, underlying bond, where literally the loss is the full amount. So that is where the derivatives and especially the OTC derivatives are exposed to counterparty risk. And then we get into the other aspect, repos and security lending activities. What is the possibility of counterparty risk in these kind of activities? So just to define repo. repurchase agreement, right? It's a mechanism to reduce the cost of financing, right? It's probably treated as one of the best mechanisms to reduce the cost of financing because definition wise, okay, if A and B have got into a repo agreement, so A is giving securities to B, right? So he is exchanging his securities with B, and in return B is providing cash to A. And there is an agreement that A will repurchase the securities back from B at a future date. Right? The agreement says that A will repurchase the securities back from B at a specified future date. So it's as good as whatever the securities that he has given to B, they are acting as collateral for the loan A has taken from B. So the cash loan which A has taken from B, he has given his securities as a collateral. And this repurchase price generally is higher than the original selling price, whatever the cash that he has received. And the difference, whatever is what we call as the repo rate, based on the repo rate. Interest rate on the transaction plus any kind of counterparty risk that could be present. The possibility that A will default on the payment. So in general, this collateral that A is keeping with B, they have to be as much liquid securities as possible. Right? Generally, there is a government bond. So generally, highly liquid, low credit risky kind of securities are being used. And even for those kind of securities, they talk about haircut. Haircut can be applied to mitigate the counterparty risk because there is a chance that the borrower will fail and even the value of this collateral may fall. So this is a kind of a protection. So what this haircut simply says is, okay, if you have given securities worth $100, right? If you have if A has given securities worth $100, B will be giving, let's say, only $98 in the form of cash. So the 2% is the kind of haircut that is applied. Right? So to make sure that the collateral today whose value is 100, tomorrow it may fall down to 97 or 98. So one, A might default, he may not repurchase back, and B, the value before he repurchases, the value of the collateral may go down drastically in the market. So I want a protection from that as well. The collateral receiver wants to protect himself from that. And that is where this haircut is playing a role. It is primarily to mitigate the counterparty risk because of two things. One, the borrower can fail to pay back, and even the value of the collateral also can fall. And repos are really one of the extraordinary tools in the international money market. And on the same lines, if I look at repo from the perspective of the lender, from the perspective of the lender, what is it? Okay, he is purchasing the securities from A and with an intention that he will sell them back to A at a future date at a higher price. That is what is the perspective of a lender, and those things we call them as reverse repos. The product from the perspective of a borrower, if it is a repo, the transaction from the perspective of a lender, we are calling it as a reverse repo. So basically we can say the repo is a kind of a loan using the collateral, so to mitigate the counterparty credit risk in the process. But still, there will be some risk that is still residual. Now, okay, I have given a loan, I have taken a loan by giving my securities as a collateral. Now, is it that the counterparty risk is completely eliminated? Now, this is where we keep seeing that there is still some amount of residual counterparty risk that can exist. Right? Now, look at it. The seller. Now, let's look at from both the dimensions. Someone who has sold the securities, A in our earlier example. Someone who has borrowed by selling the securities. One, this party may default. He will fail to repurchase the security at the maturity date. And because of this, probably the person who has borrowed, the party who has bought the securities, who was the lender, right? So that party, they have to liquidate those securities. They have to sell those securities in the market to recover the cash that is lent. And by that time, they wanted to do that, the securities value might have gone down because of the market movements, and it is not sufficient to cover this amount. So that is where we talk about over collateralization, haircut. Right? Haircut is one form of over collateralization. If you are giving me a collateral of 100, I'll give you a loan of only 95 or 98. And we also do a daily mark to market. Right? We do the settlement on a daily basis. Wherever the value of the collateral is falling short drastically, I may ask for a very heavy, again, a redeposit of the collateral. But still, there is a possibility of a gap risk. Probably if I start asking, if I am doing a daily mark to market settlement, what if the loss comes within the day? That is the gap. Right? The settlement is happening at the end of each day. But what if there is a significant price change during the day? Market moves quickly in a short space of time before the default. Now this is what we are calling as the gap risk. Similarly, now look at it from the other perspective. Who is B? Who is the lender? So if the value of the security has risen, okay, you see here, you have given me collateral worth 100 and I have given you the loan worth 95. And the agreement is after few months you will be paying 97 and I will have to return your collateral back, securities back. But during this period, let's assume that the value of the securities have gone to 105. So it looks as if I am giving you your securities worth 105 for just 97. Now this is where probably this party may be unwilling to give the securities back. So there is a possibility that even this party may not adhere to the terms of the contract. So if the value of the security rises, this is when the borrower will experience the counterparty risk. Now, if the over collateralization is very, very high, there is a good chance that even the borrower can get into a counterparty credit risk. So, the counterparty risk in a repo transaction, we see that there are so many factors that are influencing it. One, the maturity of the contract. The longer the maturity it is, the riskier the scenario is. The liquidity, how liquid is the security, how comfortably the security can be sold in the market, and what is the kind of financial health of the counterparties who are involved in the contract. All these things determine the security risk or the counterparty risk in this repo transaction. Now, similarly, if I talk about security lending kind of transaction, here we are talking about one party borrowing, similar, right? Again, if A and B are getting into a securities lending activity, So let's say A is borrowing securities from the other. Here A is borrowing the securities from B and he is providing a collateral of a comparable value. So it's as good as a repo transaction. But the only difference is securities are exchanged, not the cash. So I am borrowing securities, I am not borrowing cash. I am keeping a collateral, I am borrowing the securities but not cash. So in a typical repo, there is a cash on one side, whereas in a typical securities lending, there is no cash. So the collateral that we are using here is slightly wider. I can use bonds or other securities as well. And even there could be a mark to market kind of margining and all, which does exist as a part of repos. So the risk wise, more or less, lot of things that are applicable to the repo transactions, they are very much possible with respect to the securities lending activity as well, right? Now we can look at the different, now that we know different sources of counterparty risk and different transactions where counterparty risk can very well arise. Now we are talking about the various ways in which I can mitigate the counterparty risk. So there are different mechanisms. Generally we talk about netting, one of the very powerful mechanism. I'll have a separate session towards netting. Then we talk about collateral arrangements that could be made, which can reduce the counterparty risk. And we all have to appreciate the fact that the counterparty risk is very much bilateral. Any party can very well be exposed to the counterparty risk. So in case of netting, just to define, it is doing the offsetting. It is doing the offsetting of the amounts that between two parties. Okay, how much A owes to B and how much B owes to A. So the total, let it be netted off. In case the party has defaulted, let this total be netted off and one single amount. So the net amount will be paid either by A to B or by B to A. In case of default, netting does this offsetting of the amounts that are owed to a party and owed by the counterparty. And here there is some, not all transactions can be netted. There are some limitations. So only a certain type of transactions can get into the netting process. We'll talk about them slightly later. But that is how netting helps in reducing the counterparty risk. And the other source, the collateral, it can reduce the risk even more further. To a large extent, theoretically, if I have to talk about, it can even eliminate the counterparty risk. But what happens in the process is various other operational risks are going to surface up and various other risks, liquidity related risks, legal related risks, they are going to crop up, which means the collateral is actually transforming a counterparty risk into other forms of risk. And the third form, which we have already talked about, if I am having an exchange based trading where there is a central counterparty, even that can reduce the counterparty risk because there is a lot of mutualization of the losses that occurs in the process. But here the problem that comes is the central counterparty can create a much more bigger moral hazard. If the central counterparty fails, the systemic risk is going to be too drastic. There is a moral hazard, asymmetric information. This kind of problems are very much heavy. Because see, now central counterparty is handling a lot of these settlement processes. Now let's say A and B. Now what is happening? Earlier A and B used to monitor each other. But now because of the central counterparty existing, A will interact with the central counterparty, B will interact with the central counterparty. Now the incentive for A to monitor B or for B to monitor A, and that incentive to monitor carefully the counterparty risk of the others is getting eliminated, because it is that this particular central counterparty will take care of the entire process. Now that is where the additional risk is coming in because of the central counterparties. And today, one more mechanism of mitigating the counterparty credit risk is again different kinds of credit derivatives are present. Lots and lots of innovative credit derivatives are coming up to hedge against the counterparty risk. We have what are called as contingent credit default swaps, contingent CDS, CCDS, credit default swaps, contingent. They are developed exclusively for this purpose. So these kind of derivatives, what they are trying to look at is they are focusing on diversifying the counterparty risk, wherein you can reduce the exposure to one single client of the firm who are expected to default, and you take the exposure to those parties who are the competitors to that particular client. So in a way, it is very much creating a kind of reduced business with that particular counterparty, which is having a higher probability of default. But what we are seeing in all these things, though counterparty risk has to be mitigated, I look at it more like a double-edged sword. Why? It is not necessary that overall risk is reduced. Lots and lots of other risks are going to crop up because of this counterparty risk, right? It can go to such an extent, it will not necessarily reduce the overall risk, but it can allow the potential financial markets to develop so quickly and reach to a dangerous size. And that could create a big systemic impact. So there has to be a good balance between what is meant by good risk mitigation and what is meant by bad risk mitigation, and that is where the counterparty risk mitigation measures should really target towards. Alright, then we will talk about different kinds of players who are operating in the counterparty credit risk market. So we classify broadly into three broad groups, the players. One, we have large derivative players who are very big players in the counterparty credit risk market. Then we have medium derivatives players, and we have very small derivatives players. How do I differentiate? Here we see a large bank, very super large banks which are typically acting as dealer banks. So they have good number of OTC derivatives on their books. So they are dealing with the maximum number of clients, a good number of clients. So they trade among each other, all the large derivatives players along with various other clients, right? And they cover almost all asset classes, right from interest rate derivatives, forex derivatives, equity derivatives, credit derivatives, commodity derivatives. So they are the ones who are willing to post collateral against the positions, because they do have large number of liquid securities. They are ready to post collateral against their positions. But when we talk about medium, okay, it's a slightly smaller bank, or any other financial institution like hedge fund, pension funds. So they do have a lot of OTC derivatives on their books. Comparatively, though may not have these many clients, but slightly decent number of clients is what they do have. Though they cover all asset classes, they are active only in a few asset classes. Right? They are not active in all of them. So they, in some cases, they do post collaterals, and in some cases they do not. Some exceptions do come up. Whereas when we talk about a small derivatives player, here we are mentioning a big corporate firm or a kind of government sovereign. They are very big in nature, but they have a significant derivative requirement. Even a small financial institution, they have a big derivatives requirement. They trade in OTC derivatives, but very small. The size is smaller compared to medium and large term players, right? And only very few counterparties they actually get in. They don't deal with a good number of counterparties, very few of them, and hardly one or two asset classes is what they really try to specialize in. And they cannot commit to any kind of collateral postings. And even if they post, they don't have liquid collaterals. They get into a lot of illiquid collaterals to be posted. Right? So on a broader scale, if you look at, so these guys, they have very high credit quality. Large derivatives players, they have a very high credit quality compared to others, but even smaller, because they are big corporate and sovereign, they can have a very strong credit quality as well. And this is where they use this kind of ratings which they have, probably a AAA rated kind of ratings if they have. They want to use this to get some kind of favorable terms when they are entering into a contract with the counterparty. They want to get some kind of favorable term where they want to get into one-way collateral. So they will ask the counterparty to post the collateral, but they will not post the collateral. So that is the way they try. They assume themselves to be default free, and that is where they can very well ask or negotiate some such kind of activities from their counterparties. But the 2007 credit crisis has very clearly brought out there is nothing called default free. Bilateral nature of the counterparty risk is present always, because we have seen many large players have really performed badly during the crisis period. So we can very clearly say that not all institutions facing the counterparty risk should take it seriously, right? They have to build their abilities in quantifying the counterparty risk, pricing it properly, hedging it properly. So different activities have to be typically specialized to get a hold on the counterparty risk. So it is as simple as no institution has a poor credit quality, that they need not concern themselves with the counterparty risk, and no institution is having super normal or super strong kind of a credit quality that they will not post collaterals. So at any point, this company can become much bigger and get exposed to more counterparty risk. These companies may become much worse and can default at a future point in time. So I can't take anything for granted, which has been very much observed from our 2007 credit crisis. And apart from all these players, we also talk about so many third parties that play, apart from the ones who are front-ending the activities in the derivatives market. We have a large number of third parties also who are working in the counterparty risk, who take part in the counterparty risk. So there are parties who are doing collateral management, right? We'll talk about collateral specifically in a separate topic altogether. There are software companies which are specializing in developing the risk products. There are trade compression players who are involved in the trade compression activities. Then we have clearing services. So different kinds of roles that are played by third parties in the counterparty risk process. So their entire aim is to facilitate the reduction of counterparty risk and probably increase or improve the operational efficiency of this entire process. That is where the derivatives market, OTC derivatives market per se, can very well grow up in the future. Alright, so this is what would look like a very brief introduction to the world of counterparty credit risk. Thanks a lot for listening to this session. Thank you very much. In this session, we will be talking about some of the key components and key terminology that we use with respect to counterparty credit risk. So, first of all, we will be discussing about what do we really mean by credit exposure. We'll try to get a clarity on that. And then we will move on defining what is default probability or probability of default. Then we'll look at credit migration, another important word. What is credit spread? Then we'll try to understand again a combination of words, recovery along with loss given default. How are they, what are they and how are they linked? And then we are going to look at different kinds of costs as a part of the valuation. What is the mark-to-market valuation versus replacement cost? Right? How do they differ? And finally, we will be touch basing on different aspects of mitigating the counterparty risk. So these are the things we should cover as a part of this session. So let's get started. We will look at the credit exposure. How do we define this? So basically it's a loss if a particular counterparty defaults. That is what we can simply define it as. The loss that can crop up if the counterparty is defaulting. But here the important point is, for any financial instrument, in any financial instrument, I am looking at the positive value corresponding to a claim. If in a particular derivative transaction, the value of that derivative at any particular point in time is positive, that means if the counterparty is defaulting, I'll have a claim on the defaulted counterparty. But if the value of that derivative is negative, right now at any point in time, let's say forward or swap, I'll try to find the value of it. Right at the time when the counterparty is defaulting, I'll find the value of the derivative instrument. If that value is positive, it means there is a claim on the defaulted counterparty. But if the value is negative, I have to pay to the defaulted counterparty, which means I'm not going to get any kind of a benefit. So simply put, if any financial institution owed money, if any financial institution is owed money and the counterparty is defaulting, then they are actually incurring a loss because they have to file a claim against the defaulted counterparty. But if they owe the money to the counterparty and the counterparty is defaulting, they cannot gain. That is how we define the credit exposure. Right? So in case they are positive, they have to receive money from the counterparty and the counterparty has defaulted, they are getting into a loss. But in case the value of the derivative is positive, they have to pay money to the counterparty and the counterparty has defaulted. They cannot cancel that transaction and they cannot gain out of it. This is a very interesting aspect with respect to credit exposure, right? Another dimension. It is very much time sensitive. Today the exposure could be different. In the future the exposure could be different because the default of a counterparty can happen at any time in the future. So I really need to compute the exposure not just at this particular point in time, but also with respect to the potential future exposure as well. What is the potential that the company is going to default in the future? But at any point in time, the creditor is not at risk for the full principal amount. It's only the difference between the two payments. The net payment is what is the amount that is at risk. So, which is nothing but the replacement cost of that particular derivative transaction is what is the total risk that at any point in time the party is facing. So, whenever we are talking about measuring the exposure, we are looking at one, the risk that is occurring from the actual claims that have already, the current value being positive and the counterparty has defaulted. So, that is the amount that the company has to receive. Along with that, we are also looking forward to the potential claims, the claims that can come up in the future. So we are talking from these two dimensions. This is where we talk about what is the current exposure of the firm, the maximum loss that can occur if the counterparty is defaulting today. Whereas when we talk about the potential claim, we are describing what is the exposure in the future. What could be the loss if the counterparty defaults at some point in the future? Now, this might be much easier to answer, but this could require a lot of predictions, models, etc. So, this becomes more and more complex, right? So, whenever we are talking about or defining the exposure, it's straightforward. It is the loss which I can relate it to the value or the replacement cost that could be incurred under the assumption that there is a zero recovery. The value of the derivative or value of the transaction under the assumption that the recovery is zero. And this whole definition of the exposure is coming up only conditional on the counterparty default. If the party has not defaulted, the exposure has no meaning. Only if the party has defaulted, we are talking about the loss which is equal to the value or the replacement cost, where I am very clearly assuming that the recovery during the process is ultimately zero. Right? So the exposure is more and more relevant only if the counterparty is defaulting. Another important point regarding the exposure, the way we are computing, we generally consider the exposure to be completely independent of any default event. But in reality, that need not be the case. While computing it, we are making an assumption that it's independent of any kind of default event. So there is no possibility of wrong way risk. Wrong way risk, just to mention, that if the relationship exists between the exposure and the counterparty default, the kind of consequences that come up is what is associated with the wrong way risk. I'll talk about the wrong way risk slightly later on in a separate session. But just to give you an input, if at all there exists a strong relationship between the exposure is nothing but we are talking about how much amount that would be lost, and the counterparty default, then we are actually bringing in the wrong way risk. And what we are saying here is the exposure we generally compute independent of the default event, which means we are not assuming any kind of a wrong way risk to be present while computing the exposure. So we are not considering wrong way risk while computing exposure. We are not considering any kind of recovery while computing the exposure, and we are saying that the exposure is the amount which is the positive value of the loss if the value of the derivative is positive, and you cannot gain if the value of the derivative is negative. So probably you can very well mathematically, if you have to represent exposure, I can very well talk about it as the maximum of the value of the derivative comma 0. If the value is positive, I'll get the exposure as a positive value. If the value is negative, I'll get 0 as the value of the exposure. Mathematically, this is the way I can represent the exposure. But the point is, I have to measure the exposure which is as of today, which is the current exposure, as well as for the future, which is the potential future exposure. Right? So this is what we really need to know, first of all, as basics terminology regarding the exposure. Then we'll move on to the next aspect, where we are talking about default probability. We will bring in credit migration here, right? Moving from one credit rating to the other, and we will also talk about the credit spread. So we all know that when we are doing the counterparty risk, I need to do a credit quality assessment of my counterparty, and that too, it should be assessed over the entire lifetime of the counterparty or lifetime of the contract or the transaction. In some cases, that time period could be much longer. So here our intention is to understand what there are two things with respect to credit quality. One, what is the probability that the counterparty will default in a particular time frame, over a particular time frame, or what is the probability that the counterparty will have a downgrade in the ratings. Credit downgrade can happen during a particular time frame. So it could be 1 year, it could be more than that. But here, whenever we are talking about credit quality, we are bringing in either the probability of default as well as the probability of downgrading to a different rating altogether. And this could change with time, right? So this is the one that is influencing the term structure of the default probability. What do I mean by the term structure here? What is going to be the default probability with the time to maturity? And in many cases, for different kinds of securities, the term structure is going to be very much different. So now, very common observations. If you look at future default probability, some of the observations that came out here from the empirical data, future default probability generally decreases compared to the current. So let's say a simple example. If I want to find out the probability of default between, let's say, 20th and 21st years, this number will be very small. Not that the company is very much credit worthy, but if it had defaulted, it could have defaulted much before the 20th year itself. Right? If it had survived until the 20 years, probably the chances of defaulting between 20 and 21 are much, much smaller. So it's nothing to do with the firm being credit worthy, but it is very there are two ways. One, it is very unlikely to survive until 20 years, and if it has really survived, defaulting between 20 and 21 is much, much small. So with both the things working out, I could clearly say that probability of default in between 20th and 21st years is much, much smaller compared to probability of default between 4th and 5th years. Right? So that is what I meant to say. The future default probability, that the probability that it will default at some future particular date, that has a tendency to decrease, because there is some chance that default may occur before the start of the time period itself. So that is one key observation that we talk of probability of default. Any counterparty where we are expecting a deterioration of credit quality, when we are expecting a deterioration of credit quality, will show increasing probability of default with time. Whereas where we are expecting an improvement of credit quality, it is going to demonstrate a decreasing probability of default over time, which is what a very common sense kind of an aspect. And another important thing with respect to default probability is we are talking about the mean reversion characteristic in the credit quality. That is what we have experienced it historically. So which means if the credit quality of the firm currently is good or it is above average, they tend to deteriorate over time. So which means their probability of default will increase with time. But if the credit rating of a particular firm is poor today, we are expecting that the counterparty will more likely default in the short term, but in case if it has survived in the long term, the chances of it defaulting are much, much lesser, which means with term the probability of going default is going to decrease. So this is where the term structure plays an important role. Right? If a credit rating of the company is really good today, I can see that it will show some kind of downgrade in the credit quality at a future date. But if the credit quality of it is poor today itself, the probability of it showing an improvement is much higher in the future. That is what we mean by the mean reversion feature associated with the probability of default. Now, another important point is whenever we are bringing in default probability, we have to really understand whether we are talking about the real world default probability or the risk neutral default probability. We have two different definitions of default probability. So are we talking about the actual, which is the real world, and the actual has to be from it has to be estimated from historical data. How we do that, we have a different session where we address it. But when we talk about the actual default probability, we are getting it from the historical. Whereas when we bring in the risk neutral, which is also called as market implied kind of default probability. We are computing from the credit spreads that are traded in the market. So when we are doing the hedging of counterparty risk, this is a very important usage. I will be relying more and more on the risk neutral kind of a default probability. So how do I differentiate these two things? I'll take it up in a separate session altogether. But just we are just giving the definitions of trying to understand the different aspects associated with the counterparty risk. So the credit spread as well as the volatility of the credit spread also is something that I really need to consider when we are trying to assess the counterparty credit risk. So the three things that we are looking at: one, the credit migration, moving from one credit rating to another. We are looking at the default, the probability of default, and we are also talking about the credit spread volatility, while finally we are trying to do an assessment of the counterparty credit risk. So definitions wise, concepts wise, regarding the default probability, credit migration, at least these things you really need to be aware of. Then we'll move on to the next topic in this context, where I want to bring about recovery and loss given default. So recovery, a word is very clear. It's a kind of percentage of the claim which is outstanding that I can recover in case the counterparty has defaulted. So whatever, in case the counterparty has defaulted, whatever is the loss that I am going to incur, I am calling it as loss given default. Whatever is the amount that I can recover, we are talking about it as the recovery rate. So these two are very much linked. So I can very well say loss given default in percentage plus the recovery rate in percentage should be equal to 100%. Right? Either on default, this is the loss that I suffer, this is the recovery. This percentage can be recovered, this percentage is the loss that I would be suffering. Both to put together should be equal to 100%. And what we say is recovery rates can vary substantially. Right? They are not constant with time. So, but if you remember the way we have computed the credit exposure, we have very clearly assumed that the recovery is zero. One of the assumptions in computing the credit exposure is we have assumed the recovery is zero. But in case of pricing the counterparty risk, we'll talk about it later, we use a concept called credit value adjustment. Credit value adjustment, it is a kind of a mechanism for pricing counterparty risk, and that takes into consideration the recovery rate that is coming when the counterparty is defaulting. So it plays a very important role when we are trying to do the quantification of the counterparty risk by computing the credit value adjustment. In general, when any particular company has gone into bankrupt, has any company gone bankrupt, what generally happens is the holders of the OTC derivatives, they are, their priority wise, settlement wise, they are at par with the senior bondholders. So trading in the OTC derivatives, it looks more like senior unsecured credit risk. So the settlement wise also they have this kind of a priority. So senior unsecured credit risk is what we are talking of. But in reality there could be some level of difference. One, let's say if we are working with instruments like credit default swaps, there are different structural features that are associated with the credit default swaps where we talk about cheapest to deliver kind of possibility. We talk about optionality as one feature associated with credit default swap. Only if there is a default, then there would be a payment. So, and there could be delivery squeeze that could exist. So because of this, some kind of difference really has to exist between the conventional bonds and the unsecured OTC derivatives. And other way to look at is, in case of a conventional bond, when an issuer is defaulting, recovery rate can be realized immediately. Right, whatever is the recovery rate, I can realize it immediately because I can sell the bond into the market. There is a market for the bond, I can sell it and I can get the recovery rate immediately. But many of the OTC derivatives, they are not frequently traded in the market. No secondary market exists for them. So they cannot be freely traded or sold, which means they can't have the same level of priority as the senior bondholders. So we could see in reality there could be some level of differences, but typically consideration wise, the OTC derivatives are considered pari passu with the senior bondholders. So they reference the senior unsecured credit risk in the process. Right. So this is one important thing with respect to recovery and loss given default. Then another important term which we are interested in is mark to market along with the replacement cost. Mark to market is nothing but if at all the company defaults, what could be the potential loss? Or even if it does not default also, what is the potential value of the derivative today? So it is purely dependent on the ability to net the trades. All trades, if I have 5 trades with a counterparty A, I should be able to net all the 5 trades and finally say that this is the net value. It could be positive or negative. On that day when the counterparty has defaulted, I am trying to net all the trades. And even I should be able to compute the value of the collateral and update the net value of the transactions with respect to the counterparty. If at all I have any other hedges with the counterparty, even they should be accommodated finally to compute the value. So that value is what we are calling as the mark to market value. The derivatives, all the derivative transactions I am trying to value with respect to one single counterparty and net all the positives and the negatives, finally arrive at one single value which could be a positive or a negative one. So here if I use the word current mark to market value, what does this mean? It is not an immediate liability, right? Let's understand that it is not an immediate liability, but it is the present value of all the payments which are to be made in the future, which the company is expecting, which the party is expecting to receive, minus the present value of all the payment that it is obliged to pay in the future over many years. So the mark to market value at any particular point in time may be positive or negative, depending on whether the transaction is in favor of the institution or against the institution. Now, lot of features that could exist as a part of the transaction. One, there could be a kind of closeout netting. which is nothing but when a company has defaulted, all the trades with that particular counterparty will be closed out, and the values of all of them will be simply netted out. So that's a kind of a contractual feature that I might have entered when I got into my counterparty, or I could have some kind of termination features. I would terminate the contract the moment the counterparty has defaulted. All these things come under the heading of replacement costs. So we could say risk-free mark-to-market is very much closely related to the transaction costs, but the two need not be the same. Because the replacement cost, though it looks more and more similar to the mark-to-market value, there is a difference between the two. Because if I have to replace a particular transaction with something else, we are also considering the bid offer spreads, which are not considered as a part of your mark to market value. So additionally, I have to look at bid offer spreads, and probably this number could be much significant if we are talking about highly illiquid securities. So though the definition wise we can closely talk about the mark to market value as well as the replacement cost to be the same, but the bid offer spreads, especially the large numbers for illiquid securities, makes the definition much different. And if you generally look at another important aspect, the credit worthiness of the surviving counterparty also should be considered while assessing the replacement cost. So here we are talking about the future counterparty risk, both of the counterparty who is going to default and the counterparty which is going to survive. Both of them really need to be considered while computing the replacement cost for a particular transaction. So that's how I can differentiate it from the mark to market value. Then if I have to bring in the different ways of mitigating counterparty risk, there are different ways. Probably we'll talk about later in much detail, but if I have to just give some names, there is a process called netting, which we just introduced earlier, or I can get into a kind of collateralization to reduce the counterparty risk, or I can talk about central counterparties, central clearing or central counterparties which are doing the clearing process, like exchange or for that matter any other central counterparty, or we can talk about transactions like hedging. So different kinds which can mitigate the counterparty risk. Some of them are very simple to implement and some of them are very complex and expensive to implement. But let's understand some important things. No risk mitigant is perfect, right? If I am saying these are all the risk mitigants, none of them is perfect. And there is always some amount of residual risk that is still present. We can't ignore that. So we have to be very clear in terms of understanding what are the benefits that each of these risk mitigants is bringing in while we are getting into the quantification of the counterparty risk. And one more thing we have to understand, any of these risk mitigants, they are not removing the counterparty risk. They are not removing the counterparty risk, but they are only converting it to some other form of risk. Very important point to understand. Let's look at some netting. We are trying to net the positive value of the contracts with the negative values. Let's say if there are different trades with a particular counterparty, in some of the trades the company might be having a positive value, in some of them it could be having a negative value, so we are simply netting them and coming out with the net value with respect to a counterparty. But here the counterparty risk is reduced because the net some positives will be offsetted with the negative and vice versa. So the counterparty risk is going to get reduced to a large extent. But there is a possibility of a legal risk that is going to crop up, because there is a possibility that the netting agreement cannot be legally enforced in a particular country. Similarly, I could take collateral from the counterparty. I can have cash or securities as a collateral, which is reducing the exposure. Right? Exposure is going down because I have some kind of cash or securities as a collateral. But this is going to give rise to operational risk. This is going to give rise to liquidity risk as well. Why? One, operational, because I need to have a proper collateral management function. Liquidity, for that particular party which has given this as a collateral, there is a liquidity concern. It can't use that particular cash for any other purpose, giving rise to additional liquidity risk. Similarly, I can have central counterparties which can do the mitigation of the counterparty risk. But it can create a systemic risk. What if the central counterparty defaults? Now all those which have dealt with that central counterparty, they are facing financial difficulties. And the whole system can collapse drastically. So that though the counterparty risk is reduced in the process, if the central counterparty defaults, the whole system is going to burst out. So it is creating systemic risk in turn. And when we are doing hedging with by getting into appropriate derivative transactions in the market, but the mark to market volatility can come out, right? The volatility with the mark to market value, which could result very heavily in a market risk. So what we are trying to say is the different mitigating tools that we are using for counterparty risk. One, none of them is perfect. Two, they are reducing the counterparty risk, but they are trying to introduce some other forms of financial risk. So we have to be very careful when we are computing the counterparty risk by including all these various mechanisms which are acting as risk mitigants towards the counterparty risk. So all these terms, understanding them are very important to get a good hold on the counterparty risk. Thanks a lot for listening to this session. Thank you very much. In this session, I'm going to talk about the control and the quantification of the counterparty risk. Now this is where I want to introduce a few important concepts. So initially we will spend some time try to understand what are credit limits, how they are used for controlling the counterparty risk. Then the most important aspect in counterparty risk, which is the quantification of the counterparty risk, which is typically done through credit value adjustment or CVA in short. And uh, how do these two complement each other? Or do I really need to go with credit limits or credit value adjustment or a combination of both? So what do I exactly talk about when I am using the word CVA? What actually it represents in the real world? And we'll talk about what are the different mechanisms of hedging the counterparty risk. Right? How is it possible to hedge the counterparty risk? And towards the end, we have a small few minutes with respect to the portfolios when we are looking at the counterparty risk in the context of a portfolio. So these are the different things I wanted to look at in this chapter. So just getting started with it. We know that the counterparty risk is very substantially based on the transaction and the counterparty that we are dealing with. So we require a proper control mechanism. I want to control the counterparty risk. So one of the major tools that has been identified to control the counterparty risk is to have appropriate credit limits. The word is very much self-explanatory. So we need to have proper credit limits. But what we have seen is having credit limit, it is going to limit the counterparty risk. Yes, it's going to reduce the counterparty risk. And probably this is the first line of defense as well, right? The first immediate check to reduce your counterparty risk. But an improvement on the top of it is, how do I really quantify how much is the counterparty risk and what should be the kind of compensation that a particular institution needs to get for taking up the counterparty risk. That is what we are talking about as the pricing of the counterparty risk, and that is what we are bringing in through a credit value adjustment. So it's basically the pricing of the counterparty risk or finding the value of the counterparty risk and trying to incorporate into the pricing of the product. And obviously we know that every institution is having many counterparties, not just one. So what is really expected is the controlling of the portfolio aspect, not one single counterparty. It has to look at this counterparty risk in a portfolio perspective and then link this to the capital requirement. So that's the reason I really wanted to bring out the portfolio perspective of the counterparty risk. So this is how the flow of this session is going to look like. So we'll get started with credit limit, try to understand what it contains, and then move on towards the counterparty, credit value adjustment. Now, we have defined the exposure earlier. What is the loss if the counterparty defaults? So this is a very important definition that we are using to control. So the maximum exposure that could be there, that is a kind of a control. So the amount of risk to a particular counterparty at a particular point in time, I'm using the exposure. And we also define the word diversification, which we already know. It's we are diversifying our investment so that we don't put all in one single basket. So it is limiting the exposure to any given counterparty. So when I'm setting a credit limit, it means that I am limiting the exposure to any one single counterparty in line with its default probability. So if the default probability is higher for a particular counterparty, then my exposure to that party is lesser and vice versa. And because of this, I'm able to diversify heavily. I'm having good number of counterparties with which I can trade, and which means even if one of them is failing, the firm is not seriously affected because it has diversified its portfolio very heavily. But in some cases, I may not do too much of a diversification because in some cases, the relationships that I have with some of the clients, I may, just to continue that kind of a relationship, I may be compromising on the exposure limits also. I may be trying to increase the exposure limits with a particular counterparty because of some other benefits that I am expecting from that particular counterparty. And in these kind of cases, probably the credit exposure can become excessively large. Now, what we generally do in this process is, for each counterparty, we'll take up all the counterparties with which an institution has transactions. We clearly specify the credit limit specific to each of the counterparties. So, once we have established it, we are trying to model. We are trying to model the potential future exposure, not the current. The potential future exposure to a particular counterparty over time, and I have to really ensure that it is much lesser than the credit limit that I have established. Now, if I have not, then that is where I have to say no to a transaction with a particular counterparty because the credit limit is getting breached. So at different points in time, I'm looking at the potential future exposure and then seeing whether that potential future exposure is lesser than the credit limit that I have set with that particular counterparty itself. And this credit limit, as we have said, it is associated with the default probability and it is purely based on the risk appetite of the organization. So it is time dependent. So at different points in time, the exposure could be different with respect to the same counterparty itself. But the credit limits really are playing a role in terms of controlling the amount of trade, amount of transaction which one company can do with the one single counterparty. And generally, another important feature, the credit limits we try to reduce over time. Why is that so? Because over time, we could very clearly see that the credit quality could improve. So, and also the other way of looking at it, short-term exposure is much better compared to a long-term exposure. Because the credit quality might deteriorate over a longer term. And if it deteriorates, then the credit limit should be much lesser. And credit quality could be much better in a shorter term, which is an indication that the credit limit could be higher in the smaller time frame. So, we have also seen the mean reversion behavior. The companies which are having a good credit quality, for them the default probability is going to increase with time, which means the credit limit should be decreased with time. But those companies which are having, those institutions that are currently having a poor credit quality, I could see that their default probabilities are going to decrease with time. Because if at all they are going to default, they would have defaulted now itself. But if they have not defaulted, then the probability of default for them in the future is going to be lesser. So in that case, the credit limits could be higher for those kind of companies. So even the credit limit can be linked with the default probability from this perspective. So for the short term versus the long term, the credit limits could typically differ. And any trade that would breach a credit limit at any point in future, I have to refuse that trade. Right? If you say accepting a particular trade, I would be breaching the credit limit, then I have to simply refuse the trade. So the credit limit is giving me a kind of a consolidated view of the exposure to each counterparty, helping the organization in terms of minimizing the exposure to each of the counterparties. So it is really playing an important role in the portfolio credit counterparty risk management process, probably the first step in the same. Now, we are trying to find out the potential future exposure. I've already said. And I really want to see that the potential future exposure is within the credit limit. But while computing this, I will not be considering the possible future transactions. Only for the transactions that we have already entered into, we are looking at what is the potential future exposure for those transactions. We are not considering the new transactions that we might enter in the future. That's one important point that we have to understand. So from a company's standpoint, there should be a very clear-cut policy which talks about the credit limits, and if at all the breach occurs, is there any kind of a policy to transact further with that particular counterparty? Because as we have already indicated, there could be some kind of counterparties with which I want to maintain a relationship and I don't want to spoil the same. So there should be a clear policy which should define all these things. The circumstances under which the existing positions must be adjusted when the credit limit is breached. So we should talk about both the soft limit as well as the hard limit. So probably if I am saying, okay, for with each counterparty, the credit limit, let's say for a particular counterparty, I am saying the credit limit is 10 million. So this 10 million, I can take it as a soft limit. Because if it crosses 10 million, in some cases, I may do some kind of revision, let's say to probably 12 million. Some kind of an adjustment I may want to do. Right? Restrict the trades that cause an increase in the potential future exposure above this value. But in some cases, I may take it up to 12 million. If the market conditions are changed drastically, and I really don't want to miss out on this particular trade, so this is what I can set as a hard limit. Now, even if the market conditions have changed drastically, but if the exposure to a particular counterparty is crossing 12 million, then I may have to simply refuse the trade. So these are some of the things that we should mention as a part of our policy very clearly. And what are the kinds of credit derivatives that are typically being used to hedge this counterparty risk? Even they really need to be mentioned. But on a broader scale, if you are talking about credit limit, it is a kind of a binary process, right? Either I accept the trade or reject the trade. It's a binary. And the major drawback with this credit limit process is so many things are ignored while setting the credit limit. One, there is no explicit way that it is considering the default probability of the counterparty. Though we are saying theoretically, if the default probability of a particular counterparty is higher, then the credit limit will be lower and vice versa. There is no explicit way of computing the credit limit by taking the default probability or probably the recovery, how much is expected to recover from the counterparty, that is not considered. The downgrade probability, the probability that the rating migration is going to happen. So I am not considering the downgrade probability of the counterparty, or none of the correlations between the counterparties are considered. Everything is treated in an independent fashion. So the joint default probability of the counterparties is not considered in the process of computing the credit limit. But in reality, all these should play a very important role in defining the credit limit. Because when we talk about low default probability and high recovery, just for example, the default probability is much lower, recovery is much higher. I don't mind giving a higher limit for that particular counterparty. Right? I don't mind having a higher credit limit. But if there is a significant chance of downgrade, then I should decrease the credit limit with that particular counterparty. And let's say if for a particular counterparty the correlation between two counterparties is much higher, then if one of them defaults, the second one is also going to default. So the probability of default of both of them together is going to be much higher. In that case, if there is a high correlation between the two counterparties, I don't mind reducing the credit limit for each of them. And otherwise in a vice versa manner. So what we should see is credit limit cannot be a pure binary process. It has to be adjusted up or down based by considering these four different aspects which play a very important role in the counterparty credit risk. Right? So that's the basic understanding we need to have with respect to credit limit. Then just giving you an introduction, this is not in detail, but we will be introducing you to credit value adjustment, which is another way to work out with your counterparty credit risk, which is becoming very popular nowadays. Because when we talked about the credit limit, we said that the credit limits are set in a purely binary manner. Right? So it is very much deciding, the credit limit is very much deciding whether we need to enter into a new transaction with the counterparty or not. So if the credit limit is breached, we will simply refuse the transaction with the counterparty. Here, the major part that we are looking at is when a new transaction is coming, we are only looking at the risk of that particular transaction, but we are not looking at the return that this particular transaction might generate. So what this model of credit value adjustment is saying is, don't look at the risk in isolation. Look at the return, how much return that a particular the new transaction is going to generate, and see that if the return that it is going to generate is much sufficient to compensate the risk that you are taking, and price it into the counterparty risk. Right? Now this is what exactly is being brought out by the credit value adjustment. So the credit value adjustment is actually doing the pricing of the counterparty risk. So we are moving beyond the binary decision making process. So what it is simply saying is assess whether it is really profitable or not. Once you have considered the counterparty risk component into the pricing of the derivative. Right? So whenever we are talking about the pricing of the derivative here, we are splitting it into a risk-free price. If there has been no counterparty risk, what is the price of the derivative? Minus whatever is the risk, whatever is the component that we are adjusting it for the counterparty risk. And that adjustment we are calling as the credit value adjustment. You ensure that the profitability of a transaction exceeds the CVA. If we are ensuring that the profitability of the transaction is exceeding the CVA, then I don't mind accepting this additional, by breaching the credit limit, I don't mind accepting this credit counterparty risk as well. And that's the reason the pricing of the CVA is becoming a very interesting aspect. And what you could see is when you are pricing it, we are very comfortably considering the default probability of the counterparty, right? As a part of the formula of the computation, we are considering the default probability of the counterparty, and even we are considering the default probability of the surviving party as well, the institution, means our own our own default probability. We are very much looking at the transaction per se, any kind of nettings that are possible on the existing transactions, even they are considered, the kind of collateralization benefits that can come out. So after the collateral has been considered, what is the kind of value, and if there are any external additional hedging arrangements that are being made. So all these are taken as inputs into the computation of CVA. So it is very useful tool in pricing the counterparty risk directly. So we are not talking about an accept or reject. When we are using the CVA, we are not talking about accepting or rejecting a particular trade directly. But what we are saying is, if the institution is able to make a profit that covers that incremental CVA, it can very well take up that particular assignment, right? So that is what is a much better improvised way in assessing the counterparty risk. And here, the counterparty risk, we are talking, when we are assessing the counterparty risk, we are talking about the three levels. The levels of counterparty risk, right? This is very much important for me, because whenever I am looking at the CVA, it's not the end of all the counterparty risk. So the counterparty risk actually exists at three levels. One, at the trade level. Two, at the counterparty level, because for a counterparty there could be multiple trades. And then we are talking about a portfolio level. In a portfolio there could be multiple counterparties. Trade is one single trade. Counterparty is multiple trades with one single counterparty. Then portfolio is multiple counterparties within a portfolio. So in a trade level, we are looking at all the important characteristics of a trade. So whatever is the counterparty risk that I am assessing here, it's more of a standalone kind of assessment. So here we are trying to look at the risk mitigants associated with one single counterparty. The general risk mitigants which we talk about at a single counterparty level are the netting and the collateral that we are considering for each counterparty individually. So we are trying to do the counterparty based risk assessment at each counterparty level, and we are talking about different counterparties as a part of the portfolio. Under the assumption that only some fraction of them may default during a particular time period, I am looking at the impact that trade has on the overall counterparty risk of an institution. So what we generally say is CVA is to a large extent addressing these two aspects, whereas this is more and more covered by credit limits only. The portfolio level assessment of the counterparty risk is happening through credit limits, and counterparty level and each individual trade level assessment of the counterparty risk is happening very comfortably through a CVA. So if I have to say, do I need to use CVA or credit limit? I say you should go with a combination of both. Because as I was saying, CVA is more focused at the trade level and the counterparty level, whereas the credit limit is more focused at the portfolio level. So they should be more and more complementary. Right? They should be more and more complementary. And the other side, just try to recollect, when we try to talk about CVA, it purely talks about minimum number of counterparties. Now there is a kind of a conflicting statements between the two. CVA says go with a minimum number of counterparties because you will get the benefit of netting with each counterparty. Whereas the credit limit says go with maximum number of counterparties because that will give you a better diversification to each counterparty and it will minimize the credit limit that is associated with each counterparty. Right? So obviously even this is telling me that I have to use these two things as complementaries. They can't be a competition to each other. Right? So that's an important dimension that we really need to appreciate in this process. Then, what does CVA actually mean to us? When we talk about the price, right, when we are trying to do a pricing of any financial instrument, there are two ways to look at it. One, it's the present value of the expected future cash flows. Right? Present value of the expected future cash flows. And I am trying to do some kind of adjustments to that for the risk that is taken. Right? I am simply doing the present value of the expected future cash flows, doing an adjustment for the risk that is being taken, and that is what we are calling it as a price. And this kind of a price is what is the actuarial price. I look at the present value of the future cash flows, make an adjustment for the risk that is being taken, considering the risk premium and doing the pricing of it. But the other way of doing the pricing of any financial statement, financial product is I can look at the associated hedging strategy. If I have to create a kind of a hedging strategy for that particular financial instrument, what is the real cost that is going to be incurred? So which means what is the cost that I would be incurring to make that particular financial instrument risk neutral? So this is what is called as a risk neutral price. Now I really need to be comfortable with what is the price that I am typically talking of and where does CVA actually fit in. Is it more associated with the cost of the hedging strategy or is it the present value of the expected future cash flows with an adjustment for the risk component? Now, where does CVA actually fit in? What again the experts say is CVA is both. Because one, CVA can only partially hedge. It's not a full-fledged hedging strategy. So the CVA can only partially hedge but not fully. So even if we hedge this current exposure, we may not be able to hedge the future exposure. Future variability of the exposure we would not be able to hedge. So we must understand the hedging implication, but also we should look at the portfolio level consideration for the residual risk. So what we see is as a part of the Basel III, while computing the regulatory capital, the Basel III very clearly suggests use a risk neutral approach for computing your CVA. Very clear understandings of how do I quantify the CVA, what are the hedging mechanisms, portfolio level dimension, and how I am linking them to the regulatory capital. Right, so I need to have, with respect to CVA, we'll spend one full session in terms of understanding CVA and computing it. But what are very much required is I should be comfortable quantifying the CVA. I should know how do I hedge the CVA, what are the portfolio aspects with respect to the CVA, and whatever are the regulatory capital related rules in terms of considering the CVA. All needs to be understood in a very detailed manner. Then we'll move on to our next topic where I am trying to do a hedging the counterparty risk. I am getting into the hedging mechanism of the counterparty risk. And today the credit derivatives which have grown significantly, they are facilitating the process of hedging the counterparty risk. and it depends purely on the ability to trade the credit default swaps. But of course, it comes with a cost. But whatever is the credit derivative, especially the credit default swap that I can enter in, to that extent, my exposure is getting reduced, which means I can very well increase the kind of transactions with a particular counterparty. If I have taken a protection for a particular amount of credit, my exposure with a particular counterparty is getting reduced by that much extent, which is facilitating the possibility of transacting further with the same counterparty. That is how the credit derivatives are helping me to increase the exposure with a particular counterparty. Because when you look at it, the credit limit is now getting increased. Earlier this was the credit limit, and now because I have taken a credit default swap, I have taken a protection for up to a certain amount. So it's virtually that my netting, it's virtually that my total exposure has come down, which means I can very well take an additional exposure now, which is very well resulting in a higher credit limit for me. So when I am doing a hedging, it is increasing the credit limit by the notional amount of the CDS protection that I have simply purchased. So very good advantage is the CDS protection I will take to an extent by which I want my transaction to be greater than the credit limit. By whatever amount I want my transaction to be higher than the credit limit, up to that much amount I can very well take a credit protection using the credit default swaps. So I'm hedging some portion of the exposure in order to increase my credit limit, and that could be a very beneficial kind of a move where I can maintain the relationship with my counterparty comfortably. And there are some more products apart from the credit default swaps. We talk about CCDs, which is CCDs, which are nothing but contingent credit default swaps. It's a contingent CDS. So they are completely designed towards hedging the counterparty risk only. Because whatever is the notional, here it's not the value of the bond. Whatever is the notional that is typically getting into the protection is the exposure for a specific derivative. We are specifying the derivative, and whatever is the exposure associated with that derivative, that would be the notional as a part of the CCDS. So if the counterparty has defaulted, this would be the notional that would be paid by the protection seller to the protection buyer. So it's as good as, okay, now A and B have got into a contract, right? So so here the B, so B has, let's say, sold a bond or got into a simple derivative. A and B got into a derivative contract, and A is exposed to counterparty risk. A is having a positive mark to market value and B has defaulted. So A is exposed to counterparty risk. Now what A does, this particular company will try to buy the protection, let's say from C, where the reference is the counterparty B and this particular contract. So the reference will be made as counterparty B and this particular derivative contract which has been entered between A and B. Now if there is a default here, whatever is the value of the derivative, that would be the notional that would be settled by C. Now this way the counterparty risk can very well be mitigated. So the contingent credit default swaps much better tools in terms of hedging the counterparty risk. But here, what is the problem? The joint default. There could be a possibility that B will default, along with that C also can default. C actually who has to compensate when B defaults. There might be a possibility that C also can default. In that case, probably A is losing out both on the payment that has to come from B as well as the payment that A has made to C for getting the protection from C against B. So there are double losses that are coming up, especially when there is a joint probability of default between B and C. Now that is one important thing that stresses the need for looking at the counterparty risk at the portfolio level. I can't simply look at it at an individual level because there is a possibility that there could be a double default or a joint default of different counterparties. So we are looking at the joint probability that two or more counterparties might default. So we are considering the impact of the default probability of all the counterparties, which is very difficult to compute, but it's a very important aspect. So we are looking at things on a portfolio context, and even when we talk about the capital allocation towards the risks, it's better that I understand the unexpected losses at a portfolio level rather than at an individual level. So the capital requirement, whether it's an economic capital or a regulatory capital, which are generally acting as a buffer against the unexpected losses. So whenever we are trying to price the counterparty risk, we look at the CVA at a counterparty level. But when we talk about the concept of capital, we are trying to make the decisions at the portfolio level. So we are trying to consider both the expected as well as the unexpected losses. So whenever we have to compute the capital at a credit portfolio level, the computation is very complex because I really need to consider the correlations between the various counterparties. Between the defaults of the different counterparties I have to look at. Because if the correlation comes out to be much higher, positive, there is a scenario that multiple defaults can occur parallelly. If one of them default, the others also there is a high chance of default. So multiple defaults are possible, which means the unexpected losses could very much increase. So which means the capital numbers also should go up. And similarly, if the correlations are much lower, if one of them default, the other may or may not default, which means the unexpected losses may not be that high, which is very much resulting in a lower capital requirement. So we must understand we must understand the correlation between the counterparty defaults and also the correlation between the exposures as well. When the counterparties are defaulting, what is the correlation between the exposures? Because if whenever we are seeing that the correlation is negative or very small, the overall risk is getting reduced. Whereas when we are looking at transaction between the two parties and the correlation is very much positive, the joint default can increase the loss in the scenario altogether. So that is the reason we have to consider the counterparty risk at a portfolio level, where the focus is more on trying to understand the correlations that can exist between the defaulting counterparties as well as the exposures that are going to occur in case of default. So that's one of the prime reasons behind getting a hold of counterparty risk at the portfolio level. So these are the different ways in which we can look at the controlling and quantification of the counterparty risk. A lot of things will be dealt in more detail in the coming session, but this gives definitely give you a high level overview of different kinds of control measures and the quantification mechanisms associated with the counterparty credit risk. Thanks a lot for listening to this session. Thank you very much.